The most indebted entities on Earth are governments. The people most exposed to that debt are not hedge funds, not sovereign wealth funds. The biggest creditors in the global debt system never signed a lending agreement, never negotiated a rate, never made a decision. Someone made it for them. And the first time this structure collapsed, it took an entire city with it. Florence, 1343. Giovanni Villani is one of the most connected men in the city, a merchant, a former partner of the Peruzzi Bank, a chronicler who writes down everything he sees. What he sees in 1343 is this: the Peruzzi, one of the two largest banks on Earth. Its doors do not open. Depositors are standing outside, not rioting, not shouting, waiting for money that is lost, lent to a king who decided not to pay it back. This is money memory. The past is still running. Debt is not a number. It is a claim on someone's future. The question is, whose future? And who holds that claim? England, 1337. Edward III needs money. He's launching what will become the 100 Years' War against France, and wars run on credit. The two largest banks in Europe are both Florentine, the Bardi, and the Peruzzi. They have offices from London to Naples. They hold deposits from merchants, clergy, and noble families across the continent. They finance kings. They finance the papacy. And they control the licenses to export English wool to Italy, the lifeblood of Florence's textile industry. King Edward III borrows 900,000 gold florins from the Bardi, 600,000 from the Peruzzi, 1.5 million florins total. At the time, this made sense. At the time, it always does. And what started as a calculated loan would become a trap. This is the first mechanism, coerced lending. The Bardi and Peruzzi did not lend to Edward because the terms were favorable. They lent because not lending was not an option. The Bardi and Peruzzi held the licenses to export English wool to Italy, the raw material Florence's entire textile industry depended on. Without those licenses, their business collapsed. Refuse the king, lose the licenses, lose everything. When the lender needs the borrower more than the borrower needs the lender, power runs one direction only. Edward held access. The banks held capital. There was no real negotiation. By 1341, the campaigns in France are faltering. The expected revenues, territorial gains, ransom payments, war spoils, do not arrive. The debt cannot be serviced. The Bardi and Peruzzi keep extending. Not from confidence, from the inability to stop. Admit the loss, and the depositors panic. Extend, and the loss stays theoretical. This is the second mechanism, borrowed trust. The Bardi and Peruzzi were not lending their own capital. They held deposits from merchants, clergy, noble families across Italy and beyond, ordinary people of means who had placed their wealth with the most trusted institutions on the continent. These depositors had no knowledge of the loans to Edward, no vote, no visibility, no recourse. They were creditors without knowing it. When the Peruzzi collapsed in 1343 and the Bardi in 1345, it was not Edward III who absorbed the loss. He lost nothing. The depositors lost everything. The collapse radiated outward. Smaller banks across Italy failed in sequence. Credit contracted. Commerce shrank. Families who had done nothing more dangerous than trust a large, reputable institution found their wealth gone. 900,000 florins. 600,000 florins. Neither ever repaid. Not one. But here is the problem. The bank failed. The sovereign moved on. But the depositors had no recourse. The financing of sovereign debt moved on, financed by other means, other institutions, other depositors. Within decades, the vacuum left by the Bardi and Peruzzi had been filled, by the Strozzi, the Pazzi, and eventually the Medici. New names. Same logic. And this is the part history tends to understate. The depositor has no protection in this structure. The bank can fail. The sovereign can default. The depositor has no recourse. That's when the question stops being about Florence in 1343 and starts being personal. And if this sounds familiar, it should. The costs of running a state have not changed. Wars, crises, infrastructure, pensions, interest on yesterday's debt. Kings financed these costs by borrowing from merchant banks. Governments do the same. The creditors are still banks, still financial institutions, still intermediaries who hold the paper and pass the risk down the chain. What has changed is the structure of the depositors. In 1343, it was wealthy merchants and clergy who had placed their savings with the Bardi and Peruzzi. Today, it is pension funds, insurance companies, money market funds, mutual funds. The vehicle is different. The position in the chain is identical. In fact, the modern saver is even further removed than the Florentine depositor. A merchant placing gold with the Peruzzi knew the institution, knew the partners, could walk through the door. Today, the chain runs deeper. Your salary flows into a pension fund. The pension fund buys government bonds through an asset manager. The asset manager operates inside a financial system regulated by institutions the saver has never heard of. 3, 4, 5 intermediaries between your savings and the sovereign borrower. Each layer adds distance. Each layer adds opacity. The depositor of 1343 did not know his money was lent to a king. The saver of 2025 does not know either. The chain is just longer now. Greece restructured its debt in 2012. Bondholders, among them European pension funds, took losses exceeding 50% on their holdings. Argentina defaulted in 2001. Ordinary savers holding dollar-denominated accounts woke up to find their funds frozen. Russia defaulted on domestic debt in 1998. Local financial institutions held that paper. Their depositors absorbed the consequence. In each case, the chain ran the same direction. The mechanism is identical. Only the names change. In 2025, OECD sovereign bond debt reached $61 trillion, a record. Global government debt stands at $102 trillion. Total global debt, governments, corporations, households combined, stands at $318 trillion, a number so large it has stopped meaning anything. Interest expenditures across OECD countries consume 3.3% of GDP, close to a decade-long peak. That interest does not stay in government spreadsheets. It moves through tax rates, public services, and the real purchasing power of every salary earned. Your savings, your purchasing power, your future. Not abstract anymore. So what should you take away from this? First, the creditor is never who it appears. Behind every sovereign loan, there is a chain of intermediaries. At the end of that chain, almost always, ordinary savers who never signed a lending agreement. Second, coerced lending is not ancient history. When institutions are too exposed to exit without crystallizing catastrophic losses, they extend. That is when debt becomes structurally dangerous. Not when it is issued, but when it cannot stop growing. Third, the question is not whether governments always repay. They do not. History says so clearly. The question is who stands at the end of the chain when they don't. Today, governments owe $102 trillion. Someone holds that claim. The people holding that claim never chose to. Make sure you know if it's you. Money memory. Subscribe, so the past stops surprising you.